All right, we're seeing some participants come in. We're gonna wait a little bit longer to make sure we're starting with everyone. Welcome, everyone. If you want to drop your name and company and profession into the chat, we would love to see that. All right, I just launched an audience poll, so this will just indicate your general role, just to make sure we're speaking to everyone involved here in all of our responses. All right. Well, I am going to go ahead and get us started. So, hi everyone. My name is Taylor Sterling. I am an ESG associate with ZMH Advisors, and I want to thank everyone who showed up live to participate in this ESG roundtable conversation with this amazing group of panelists. I'm so excited for this conversation, and I know it will add a whole lot of value to this evolving ESG space. So like I was saying, there's a poll for everyone in the audience to answer, just to understand where people are coming from in terms of professional roles. And at the end of the webinar, there will be a survey asking you about topics you want to hear more about. ZMH is excited to continue hosting roundtable events, so this information is extremely valuable to us. And this webinar will be about an hour long. We're going to leave the last 5 to 10 minutes for audience questions, and you can drop your questions in the Q&A feature throughout the webinar, and we'll do our best to get to them. And as always, I want to make our blanket disclaimer here that the opinions presented in this webinar are our own and are not official legal advice. And with that, I will kick it off to Wahid Hassan to get us started.
Thank you, Taylor. Good evening, everyone. I'm Wahid Hassan, the founder and CEO of ZMH Advisors. We're excited to have an exceptional group of speakers to discuss how to manage ESG programs in an evolving regulatory landscape. Over the past few years, increasingly stakeholders such as investors, regulators, employees, and customers have demanded ESG disclosures. In the US, the rise of anti-ESG movement, coupled with SEC's climate reporting requirements, have resulted in numerous questions on how best to navigate the ESG landscape. We will try to address many of these questions in our webinar today. Let's start with the introductions. We have Renata Jones. She's Head of Legal Securities and Corporate Finance, Office of General Counsel at Organon. Welcome, Renata.
Yes, hi. Thank you, Wahid, and thank you for the opportunity to join in this conversation. I'm a practicing lawyer. As Wahid said, I'm the head of legal, securities, corporate finance, and capital markets at Organon. We're a global healthcare company focused on women's pharmaceutical products. We have a presence in about 140 markets across the world, and bringing my perspective as an in-house legal counsel and how I work with other functions in the organization to address the issues that are rising with ESG and sustainability.
Thank you. Next, we have Renee Zartsev, partner at Boyce Schiller. Welcome, Renee.
Thank you so much, Wahid. So as you mentioned, I'm a partner of Boyce Schiller Flexner. We are an elite litigation firm with offices around the country and in Europe. My practice here focuses on shareholder litigation, and part of my practice and the perspective that I bring to this is I represent companies and boards of directors and officers that deal with shareholder litigation issues arising from, among other things, ESG related matters. And I also do a lot of work in the shareholder activist space.
Thank you, Renee. Next, we have MJ. She is the founder of FinCom Services and an advisory board member of ZMH Advisors. Welcome, MJ.
Thank you, and thanks for having me, and hello, everybody. MJ Privik, ESG advisor, founder of FinCom. As Wahid said, my background is capital markets. I have practiced as a financial analyst on the sell side. I've also worked as a director of investor relations for a publicly listed company, which is actually where I fell into the sustainable reporting space. I've been following the space very closely for the last 12 years. I've been involved in advisory to companies specifically with respect to their ESG or sustainability reporting. And prior to coming back to the practice of advisory, I spent 3.5 years as Chief ESG Innovation Officer for an ESG data management software platform. So happy to be here.
Thank you, MJ. Quickly, a few words about ZMH. We are a data-driven ESG and shareholder engagement specialist. We combine proprietary data on investors, ESG preference with a team of ESG experts to build customized ESG programs. As a full-service ESG advisor, we partner with clients ranging from pre-IPO companies to those in the S&P 500 to do like everything such as like ESG strategy, perform materiality assessment, calculate carbon footprint, and write ESG reports. For most of our clients, we are the bolt-on ESG team, and for majority of them, we are the primary resource they rely on to engage with investors on ESG topics. With that, let's quickly cover some logistics. Please submit questions through the chat window. We will answer them as we go through the webinar or towards the end. In terms of our focus area today, some of the high-level themes we will try to cover is insights into how companies are managing the ESG programs in an evolving regulatory landscape, both here in the US and abroad, learn more about ESG-related litigation and how board of directors and management teams can mitigate potential landmines, and learn about the best practices for ESG data management. We have a lot to cover, so let's start with the first topic. So what is the reason behind these ESG regulations? Why are we seeing so many of them, especially here in the US as well as abroad? And what are these regulators trying to achieve? And what are the best practices for the companies? I know it's a long question, but MJ, maybe we can start with you.
Thank you, Wahid. Thanks for the honor of kicking off the conversation. I think understanding why is the starting point, and it's hugely important because there's a lot going on, and it's a fast-moving space, and sometimes can get a little bit confusing. So, you know, what is ESG? First of all, ESG is an acronym to designate environmental, social, and governance something, best used as an adjective, not a noun. So to designate issues, challenges, risks, opportunities. It actually is a term that originated in the investment space, and in the context of what's happening in the US and the regulatory initiatives that are in the US and in other jurisdictions as well, but very much so in the US. This is investor driven. This is about meeting investors' information needs, better meeting those needs. And all of that has to do with capital efficiency and market efficiency. So in the US, the regulations are very much focused on that. In Europe, by contrast, the regulations have another ambition, have a broader ambition, a greater ambition, which is to reorient capital allocation to more sustainable economic activities, to integrate sustainability into risk management, and better disclosures, better corporate disclosures is one of the ways to achieve that. So there is an information efficiency, capital market efficiency dimension to it, but there's a broader objective of shifting economic activities towards more sustainable activities. And I think we need to ask ourselves the second level why do investors care? Why are companies being asked to provide this this information? And in my opinion, there is a broad level realization that we have created a series of problems for ourselves as individuals, societies, companies, and populations that we need to be addressing. We're part of the problem, we're part of the solution. Companies are not the only ones responsible. They're not the ones who are going to solve all of our problems like climate change and biodiversity loss and income inequality and pollution, but they have a role to play. And at the base of it, this is what ESG is all about. I have a little story about the origins of ESG, but I'll get back to that if we have time.
Okay. Thank you. So Renee, related to that, now it seems like for many of the companies we talk to, they seem to consider ESG as a compliance exercise, but it's clearly more than that. So, I mean, from your vantage point, how are you advising clients and what are you seeing?
So I think that, it's important to understand that ESG and not focusing enough attention internally on ESG, whatever it is, as MJ said, it's an adjective, but on whatever the ESG thing is that matters to your business, creates real litigation risk. And I think that risk sort of boils down to two primary buckets. One is, even absent specific regulations, there are many companies who choose to speak about certain ESG related topics. There are many reasons why they may choose to do that. It could be part of the company ethos, or it's what that particular company's investors expect from the company. And so very often you'll have situations where companies will choose to voluntarily disclose statements about, for example, their diversity commitments or their sustainability goals, et cetera. And those types of statements very often lead to litigation. Now, not necessarily saying that those litigations have been wildly successful, but nevertheless, they create costs for the organization. And I think a lot of times this ends up happening in particular after something bad happens to the company. So in good times, you might think there's absolutely nothing wrong with saying, yes, we are committed to, maintaining diversity in our management ranks. Or we are extremely committed to customer safety. And then all of a sudden, you have a data breach, or your mine collapses, or your plane falls from the sky. And there are shareholders, I would say lawyers more than shareholders, that will go through your prior disclosures and find some statement that you made that may have seemed innocuous at the time, and claim that it was false. So that's sort of one area of risk. And so it's very, very important to be very thoughtful about the types of statements that are being made. And then the other risk from a board and management perspective is there is a duty of oversight, and the board and management have duties to monitor certain aspects of the business and to act when they see red flags in those areas of the business. A lot of these issues overlap with ESG. Some real world examples are, a pharma company board got sued for failing to follow health and safety regulations. An oil company board got sued for failing to monitor environmental risks. An airline board got sued for failing to oversee safety. And I think probably the most well-known example that we might have read about is the McDonald's board got sued for failing to address sexual harassment in the workplace. And so these issues are broad, they cross the organization, and it's extremely important for the board and management and everyone that reports to them to be very focused on these issues.
Great, thanks. So Tanetta, from your vantage point, considering you have both legal and in-house operational expertise, what do you see, like how are companies managing these different aspects of ESG?
Yes, Wahid, I think that collaboration across all different aspects of the enterprise is really integral to addressing the issues. People think of this ESG adjective as one particular specific issue, but it really, in order to address the numerous regulations that are imposed by US regulators, by European regulators, by regulators across the globe, there requires interdisciplinary collaboration, not just amongst the legal functions, but other functions in the company. For example, we have a specific ESG team, but the decision makers, the collaborators involve members from our communications, from environmental health and safety, from manufacturing. The finance team is very important, including our internal audit and our controller team, communications, investor relations, in addition to legal specialists such as executive comp and benefits, HR, corporate governance, and of course, securities reporting. So companies really should take a large scale overview of the stakeholders involved in being responsive to these mandates, and a holistic approach to making sure that early on, you're getting input from the appropriate stakeholders so that you're able to address how these rules and mandates and whether they do apply to your company, and how do you address putting together a response to be able to be compliant with them.
Sure, thank you. So just a follow-up question on that. So for companies that don't have a large ESG team or a chief sustainability officer, who is the champion of ESG internally typically? Like whose bucket does it fall under?
I would be, reminiscent to put that on the head of anyone. I think for each company, you have to look at how you're organized internally. It may be a function that comes from external affairs and communications. It may be a function that comes from finance because you have these audit responsibilities. It may be a responsibility that comes from legal. I find that there's really the sharing of responsibilities. Obviously, someone needs to take the lead, but that's why you have these conversations with management, and then at times you have input from the board. You talk to the board, you share your ideas with the board. How should we best address this? For example, there's some companies on a board level, it's the responsibility of audit committee. Some companies have in their nominating and governance committee, they have the ESG function. Some companies feel that it's something that the entire board should play a role in. Addressing this question is really an aspect of companies taking a look at what their focus are. It may be a different priority as Renee mentioned, an oil and gas company versus a pharmaceutical company. Companies that are highly regulated need to address a greater focus on this. And really, as I stated before, what's integral is to have these conversations early on and to not put the burden on any one person, but to be collaborative and share information across function. I think that can be a challenge that companies of any size, they face. So just a sharing of information and then collaborating together to put together a plan for yourself.
If I could jump back on that, I think I agree. I've seen it run the gamut at clients, and there are many clients we've spoken to where it's such a focus of their internal compliance that the CEO is very often involved in the ESG committee. And again, in other companies, that's not the case. Sorry, yeah. MJ.
No, that's okay. I think we're on the same wavelength, and I'll just double down. I agree with what's been said and maybe underline a few things. Completely agree. It can be different people within different organizations. It depends on the company. There is, generally speaking, a shift from prior responsibility on the comms team, or maybe the corporate social responsibility team, shifting towards finance and or legal, just because of the greater regulatory pressure and the greater investor focus and this greater connection that companies are being asked to make between their sustainability performance and their financial performance. So you're starting to see, and now the fact that disclosures are increasingly going to need to be externally audited, that brings in the finance team. Completely agree that this is, ESG sustainability issues live throughout the organization. They are great at breaking down silos. So, the collaborative work, ESG committees are best practice to bring people around the table who need to be around the table. I would add, though, that you absolutely have to have one person who has official responsibility so that things can actually get done and things can move forward. Some companies, early days, first of all, are adding these responsibilities to people who already have a full-time job. But also not designated any single one individual. So things will fall through the crack when that happens. So I think it's very important, wherever that person may be within the organization, that there be somebody who's held accountable.
Great. And from our vantage point, we see the IR department or team being increasingly involved with ESG. because at least in the US, a lot of the questions coming from investors and rating agencies, and IR is tasked to address those questions. So in almost all the engagements that we are part of, like the head of IR or the IR team is critical as part of the ESG team. So just moving ahead, so considering the regulatory nature of the disclosures, a lot of companies are concerned about litigation risk and what to disclose, what not to disclose. How should companies be thinking about it? Because we hear that some companies are thinking, oh, we should put the pens down and just disclose as little as possible, or some companies want to be at the forefront of disclosure. How are you guys advising companies, and what do you see from your vantage point? Renee, let's start with you.
Sure. Well, look, I think every company needs to make a decision, first of all, whether they want to be, an ESG leader or follower, in the sense of, some companies, as I said earlier, do choose to be more proactive about the disclosures that they make, and some companies choose not to say anything. And they'll be very happy to know that there was a Supreme Court decision earlier this week that supports that there probably can't be any liability if they choose to say nothing. But investors might not like that, right? And so there are a lot of reasons, even though the most risk-averse solution might be to say nothing, from a legal perspective, that may not match with your investor preferences, and that might not be the way to maximize, what the value you're bringing to your investors. I think it's extremely important, as I said before, to be thoughtful about the statements that are being made. Probably the best way to protect against potential liability is through something called forward-looking statements. So when companies make statements about the future, as long as they are identified clearly as forward-looking statements and are accompanied by appropriate disclaimers, it's very difficult to for a plaintiff to tag the defendants with liability for statements like that. So it's important to, of course, work with counsel to make sure that all of those elements are in place so that you're most protected. But as I said before, sometimes the statements that companies want to make are not necessarily about the future. They're about things that are happening now and things that the company is committed to now. And so, we can be as careful as possible with those things, but there's always going to be a plaintiff out there who, like I said, when your plane falls out of the sky, something in your 10K can probably be hooked to bring a litigation if someone is motivated enough.
Yes, and I'll jump in on, Renee's statement about, companies making a decision maybe not to speak. The fact remains that mandatory climate disclosure for U.S. companies is here. And in several key jurisdictions, companies will be required to disclose climate-related information within the next few years. So they need to take action now to determine what disclosures actually will apply to them, and then to put into place the infrastructure to be in a position to develop and collect and report information to address those requirements. So, we talk about how obviously they're companies of different sizes and they have different focuses, and they're, for them to determine how they want to approach it. But the fact remains that some requirements related to ESG are in existence now for companies in the US, and then for those companies that are impacted by CSRD and other rules, there are even broader implications on their requirements to disclose and to be compliant to those obligations.
If maybe I can add a few things to complement what's been said. Obviously, again, agree with everything that's been said. Bringing it back to the question of the why of regulation, I mean, the question is, it takes us into two different directions. There's the complying with the regulations in place, and then there's well, if the regulation doesn't force you to disclose, do you not say anything? And then the litigation on things that might happen that have actually not necessarily anything to do with regulation. Beyond regulation, why are we talking about all this is because the users of the information, the counterparties, I call them business counterparts and stakeholders of the company, want to know. Investors want to know, bankers want to know, insurers want to know, You're seeing insurance companies now pulling out of markets, and there are markets that are uninsurable because of the climate risks. They're going to start asking questions. And that affects the cost of insurance. It'll affect the cost of debt. Large customers want to know. It will affect whether or not you as a supplier get the contract, or how much you will get from your large customer if you do or do not disclose or do not disclose, provide information on how you are managing those things. Stakeholders want to care because they want to know because they care. They care because it matters to the decisions that they make. Forward-looking decisions. So beyond the regulation, there are market pressures to provide this information, and there's a competitive element. Absent any regulations, if other companies are doing it because they're being asked to, and they're saying, okay, you want to know, here, I'll tell you. If you're not doing it, then your stakeholders, business counterparts might just say, well, you're not telling me. I don't know. I can't know if climate is a risk for you. I can't know if you're managing your human rights in your supply chain or in your manufacturing. And if I can't know that's a risk, I'm not willing to take. The reason regulations are coming into play, particularly the SEC regulations, is because they want to level the playing field. They want the information to come to the market in an efficient way and in a comparable way and in a reliable way, so that the users of this information, obviously investors and other capital providers, can have what they need to do their work and to make their capital allocation decisions. So the two are connected. And I just wanted to come back on one of Renee's points earlier, because I think we need to dig into that a little bit, which is Renee gave a lot of good examples of litigation on things that happen in a company's business that people care about, employee health and safety and, sexual harassment cases, or, those are all important issues. The litigation arises in connection to disclosures because there might be a gap between what the company says it does and what it actually does. So at the end of the day, this is also about walking the talk, integrity. You don't have to say that you're a wonderfully sustainable and green company. But if you do say those things, you need to be able to back it up. You don't have to say that you have a plan to be net zero by 2030 or 2050. But if you do, you need to be able to back it up. And again, this is where the SEC climate disclosure rules step in. They don't force you to have a decarbonation plan, but they say if you're going to claim you have one, you need to be able to say how you're going to get there. And so it's that walking the talk, and you don't have to say those things, but if you're going to say them, be prepared to be held accountable to them. So I don't know if you want to come back on that now or later on, but I thought that was a really interesting point.
If I could step in, I think that MJ made a very good point in talking about the transition where, some people may think of ESG as a feel-good thing. We want to address these types of issues because we're good people and we care about the environment, we care about social issues, we care about governance. But at the end of the day, what people really do care about are shareholder engagement. They care about what the investors want to hear. And I think MJ did a really good job of laying out the financial implications and how this can help one company differentiate itself from each other, from another, how black and white issues such as insurance, how they impact. When you look at the implications of ESG reporting, disclosures, compliance, how they may impact the bottom line of a company, that's when people actually start to listen and pay attention, and they start to be concerned. Some of us, want to have the warm and fuzzies, but most people really, when they think about share price and then protecting resources that may otherwise be going towards litigation, that's when people start to pipe up and pay attention. So really appreciate you bringing that point up.
Those are really important aspects, because as we are advising our clients on ESG engagement with the top investors, we see investors continue to ask questions on ESG topics. We have not seen any pullback from investors on these topics. And importantly, we're seeing up until 2 years ago, most of the discussion from the investor perspective was about disclosure. That has now shifted and it's moved from disclosure to how is ESG integrated as part of the strategy? Do you have products and services that align with the new sort of green related opportunities out there, right? So investors are asking a lot of these questions, and what we also see some of the investors taking a hard stance on these issues and saying, if you don't have this disclosure, you cannot be part of my portfolio. Why? Because the asset owner, people who will see this massive wealth transition from like the baby boomers to the millennials, right? They are demanding these from a portfolio company. If as investor, we invest in a company, our asset owners want us to invest in companies that have these kind of alignments, ESG alignments. And unless you disclose, there is no way for us as asset owners and asset managers to make sure that we comply with the requirements of our asset owners. That is a huge pressure point that is driving companies to disclose and engage with investors on these topics. At least that is what we see on the investor point perspective. So I think, Latinetta, we talked about ESG disclosures and like a lot of different elements within the organization are providing this data, right? How do we ensure data consistency, right? How do we make sure that whatever data we collect today is relevant next year, or we don't have to go back and restate the data? Because those are some of the challenges many of the companies that we work with are facing and trying to address proactively.
Yeah, so that kind of brings into the point, getting the right people involved in the conversation early on. The disclosure requirements differ among the ruling body. We talked about materiality is something that's, you know, top of mind for companies, and you have to disclose what's material. But there are key distinctions to be made between materiality for the purposes of CSRD reporting, materiality in terms of sustainability reporting in general, and materiality from a legal perspective. It's a legal construct when you talk about SEC reporting requirements of materiality. And one, you know, thing that the community was really happy to see was that with the SEC climate rules, they did give some really good guidelines on how companies determine what's material to them in terms of reporting on climate issues. But again, this is a particular aspect of the reporting requirements where you want to make sure that you have your legal team involved and that your ESG team or your non-lawyers understand the difference between materiality from a CSRD perspective and a materiality from an SEC perspective. And the important thing to note is there may be different disclosures in these reports, but it's important that the disclosures are consistent. You don't want to, you may have to report, let's say, A, B, C, and D to be compliant with CSRD, and you may only need to disclose A and B to be compliant with the SEC, but you have to make sure that you are consistent in those disclosures. And I think that MJ had a lot of insight to add to those discussions of materiality.
So if I could I jump in before MJ?
Yeah.
So I think because materiality is such an important word under the US reporting regime, I think that, you know, it's probably beneficial to stay away from using that word outside of contexts that actually require disclosure of material information. There are synonyms, relevant, important, things like that. I think that that's one thing that helps mitigate litigation risk, because when you disclose something under one reporting regime and call it material, it might not be material to another, but those are the types of things that get put in front of a court as a supposed admission. That's number one. I think the other thing to remember is that when you do speak, whether it's because you choose to speak or because you're required to speak under a regulation, you have a duty to speak truthfully and you have a duty to speak completely for that statement to be true. And so, you know, there has to be a discussion over kind of what this company wants to do over the long term. If you're going to disclose certain types of information and then not disclose it in the future, you might have a duty to update your prior disclosures if something materially changes. Again, I know these are general comments because they're so different from organization to organization and from specific situation to specific situation, but we really need to be thinking about not only the accuracy and completeness of a disclosure today, but how the accuracy and completeness of that disclosure might be affected over time and what the company plans to do going forward.
And Renee, just before MJ, I still want you to pipe in here, but CSRD actually does have an obligation for material disclosure. And CSRD, they define what a company's obligations are in term, and they use the term materiality. So don't think it's just black and white and saying if you're not talking about SEC or US legal to not use the term materiality. And I think that's where MJ kind of has some good insight.
Right. I think it's just important to be clear what standard you're referring to so that it's not taken out of context and used as an admission that something was material and should have been disclosed under reporting regime A when it was disclosed under reporting regime B.
Yeah, so, we will be talking about materiality for many, many, many months, if not years to come. It's a subject that is top of mind for anybody in the sustainability space. And as we're getting more and more into regulated disclosures on sustainability, ESG issues, it's taking even more space. What I want to underline from what's been said so far is this idea of consistency in disclosures between the different documents, between the different jurisdictional obligations, and the consistency, to Renee's point, over time. In other words, you can't decide one year to talk about something and the other year not. And the concept of materiality, especially in the States, is not an obligation to disclose everything about everything in your business and leave no stone unturned. There are confidentiality, not rules, but practices that can and must be respected. And the idea is not you have to disclose everything. It's more, if you disclose, it has to be done in a fulsome way that leaves no room for confusion and misinterpretation on behalf of the users who are getting this information. So that's my interpretation anyway. I should have started the webinar by saying I'm not a lawyer. My interpretation of the legal definition of materiality in that context. To be fair, materiality is a word, is a ubiquitous word in the sustainability space, sustainability reporting. Where there's a nuance is in describing a material issue or matter versus material information. And so in securities regulations, up until now, the definition has been about material information, which, by the way, is separate from the accounting definition of materiality, for which there is a threshold of what constitutes a material accounting number, below which you don't need to talk about, above which you have to. That's a separate concept altogether. There is no, I think it's called like a bright line limit or determination of what constitutes material information, even less so what constitutes a material topic. So the determination of a material topic is something companies have to do for themselves to figure out what are the issues that matter to their business. There can be many perspectives. There's the financial materiality perspective, the impact materiality perspective. These are just different perspectives or lenses of materiality of what will make you see if an issue is material or not. But that doesn't change the fact that companies have to figure out for themselves what those topics are. But that is, it's defined in the European standards to a large extent, but the European standards also specify companies have to do that work, have to go through the process. And that's actually, a lot of companies in scope for the CSRD right now are scratching their heads and trying to figure out, how do I do a double materiality assessment, and going through a much more fulsome process than simply sending a survey to all their stakeholders on all the possible topics that could be material to their business. But anyway, hopefully that brings probably it doesn't completely clear up the topic of materiality, but hopefully brings a bit of color.
Thank you, MJ. And from sort of an execution point of view, what we see among our client base is in terms of ESG data management tools, there are many of them that exist out there. The biggest challenge becomes like if you don't have someone within the organization who's well versed in a lot of this ESG terminology, it's garbage in, garbage out. So they don't even know what to enter into the system. So it goes back to, and for several companies, the issue is we have to conduct a materiality assessment, not in the accounting term or the legal term, but let's do a materiality assessment, go out to our stakeholders like customers, employees, and investors, and ask them like what really matters to them. And that becomes a key input into the ESG program and what will drive the ESG program, and also what data they want to collect to begin with, right? So a lot of this, like what MJ and Ternita and Rennie was talking about in terms of like materiality, it really from an ESG lens, it is trying to understand what is material to our key stakeholders and sort of then collecting the data. But data collection is not an easy exercise in itself. That is what I think a lot of companies realize.
I would say, sorry, to double down on that, data collection is not easy. And by data, we can include quantitative, numeric, and qualitative text. Data collection is not easy. It is also not the starting point. It is the middle of the process. The starting point is, what do I want to collect data about? And that is the material issues. There's dozens of ESG sustainability-related issues. They are not all material to all companies. It depends on context. It depends on the industry, on the business activities, on the geography, on the jurisdictions. It depends if you're looking at your core business, your value chain, upstream, downstream. Are you looking short-term or long-term? Those are all the different considerations of what goes into a materiality assessment. But if that's the starting point, what are the important issues I need to manage? And then figure out, okay, well, how am I managing them? And then, okay, well, what's the data I need to collect to know if I'm doing a good job or not? And that's ultimately what ends up going into the disclosures. That's what investors, users want to know.
Absolutely. So Renee, the next question is for you. Like we see like that the SEC climate regulations have been challenged, and some of the companies are thinking, should we hold off on preparing for these disclosures, or should we continue to march forward with building the internal infrastructure to collect the data? Where do you see this going, and what are you advising your clients?
Sure. Well, I think just taking one step back so that everyone knows what we're talking about. A few years ago, the SEC put out proposed climate change regulations regarding the disclosures that companies should make. And these are pretty sweeping regulations. They were just voted to be finalized in March. And although the final version of the rule eliminated one of arguably the most sweeping aspect of the rules, they are still incredibly broad. As you mentioned, Wahid, they were immediately challenged in court, and then I think in a surprise move, the SEC voluntarily stayed the rules. But I think that leaves companies in a challenging position because given the nature of some of the disclosures that are required to be made, and there's a sort of a phase-in process for when the rules would become effective, depending on the type of disclosure and the type of filer that you are. But some of the disclosures, if you want to have a hope of complying with those disclosures, if and when the rule becomes effective on the current date that it's supposed to become effective, then you can't wait until the last minute. You really need to be thinking about those things now. I think there are some companies that are thinking that the rules probably will never go into effect and are doing nothing. I think that frankly, that's a risky place to be. And so I do think that putting some preparations in place to make sure that if you're not going to at least start taking the concrete steps, at least map out what steps you need to take once that challenge is resolved so that you can get on it quickly. But I also think I'm going to kick it to Ternita because I think that there's a separate independent reason why a lot of companies might want to start taking those steps today. From the European perspective.
Yes. So even, notwithstanding any, objections to the SEC climate rules, sustainability reporting is here to stay. And even if there are, you know, notwithstanding whatever the political climate is here in the United States, which really has a lot of impact on the SEC actions that are in place today, there some version of these rules will be in place. As MJ talked about, how this really the origins of sustainability reporting comes from investor desires in the first place. And even if you don't have any compliance obligations from the US, you may have them from the impact of European standards, or being a company that has connections or services, a company that's in Europe that has CSRD reporting standards. And, you know, a lot of, you know, focus is given to the SEC climate rules, but the SEC also recently, they came out with governance rules related to cybersecurity. And we haven't heard a lot of talk in the community about that. People just kind of accept it as this is something that we need to address now. The SEC also has in their wheelhouse rules about human capital reporting. So there are many aspects of the ESG adjective and sustainability in general that companies really need to pay attention to. These issues aren't going away because they are important to investors, and the SEC, our rulemaking bodies, they respond to the interests of investors. So I would caution companies against putting a pause on any work they're doing, and just, you know, really look to the right advisors to help them craft their plans and to be prepared for when mandatory reporting is in place.
So let me just make one more comment. I think, MJ, you made a good comment earlier where you said part of the goal of these regulations is to provide information in a comparable way. And that's really the key benefit of having a disclosure regime, because sophisticated investors will actually take company disclosures and be able to very easily compare different sections of those in a way that makes a lot of sense. Absent these regulations, I think ultimately, over a long enough period of time, the topics that are subsumed into these reporting regulations are going to become part of the materiality assessment anyway. And so what the regulations are doing is making the disclosure standardized across different companies, which is very helpful for investors. But I think that I absolutely agree that companies need to be thinking about these issues anyway as part of their own individualized materiality assessment.
Yeah, and I will again add on to what's already been said, that are all really, really good points. And the beyond the regulation, why are investors asking for this information? So we need to parse out a few things here. But with respect to climate change, you have to ask yourself, why are they wanting this information? And as a company, you need to know whether you are, contributing to the problem or at risk of the consequences of that problem. That's just good business. That's good risk management, actually. And that's the reason why investors want to know. Investors make risk-adjusted return decisions, and they want to know what is the risk of that, of my investment. And over 6 months, over 3 years, over 5 years, or over longer term. And so, do you need regulations to be forced to look at those issues and to speak to those issues? If climate is not an issue for you, if you are neither an emitter, nor are you at risk, you don't have any facilities, your supply chain isn't located anywhere where there is a significant risk of the climate effects, whether that's floods, droughts, access to water, you name it, then great, you need to talk about that. You need to tell investors that you have a low climate risk profile, and you need to be able to explain why. But I think we cannot lose sight of the fact that we're not talking about something that's extracurricular here or extra business. This is very much part of business. An example that might be, and to your point, Renee, about, it's part of the materiality assessment or needing to convey this information, whether there's regulations or not. Let's use a less perhaps controversial example of health and safety. 10, 15 years ago, I was in IR. I know you're sitting in front of, management is sitting in front of an investor, and investors want to know management. They want to meet management. They want to know that management is qualified and competent. Rarely would they ask them about their health and safety. That's under the whole good management umbrella. And they talk about cash flows. Today, what's changed is that they also want management to be able to talk about what they're doing about health and safety. So more granular information, more quantitative information, and information that ultimately also makes it into the disclosures. Not that those companies weren't managing their health and safety before, it just wasn't part of the conversation. Now it's part of the conversation. And the last quick point, because I think we should be leaving some time for questions, hopefully, but the last quick point is there's a phrase in sustainability. Actually, it's in climate a lot, and it's in everything. It's, change is happening by choice or by force. And when it happens by choice, you can plan for it. It's less painful, it's less disruptive, and it's less costly. If you don't plan for it, it'll happen anyway by force, and it'll be much more painful and much more costly. Same thing with regulations. If you wait until the very last moment to become compliant with what, by and large, many people think is the inevitable progression of regulated sustainability disclosures, you're going to get caught, and it's going to be in something that is a more painful disruption and a more costly one than if you start the process sooner. So that would be the advice.
Thanks. And just like to add to what the panelists said, if companies don't disclose this voluntarily or through regulations, shareholders have other mechanisms. We see shareholder proposals being sent, ESG shareholder proposals being sent to public companies, which is a lot more painful process to deal with and a lot more expensive process as well. So, I mean, that's is a new webinar by itself to discuss like shareholder proposals, but just switching gears a little bit, we have a few questions from the audience. One question I think that sort of ties to the future is, at least in the US, ESG has become a political topic, and we hear a lot about anti-ESG and anti-ESG movement. What, in your opinion, is the future of ESG? Would it evolve into a new terminology? I mean, we might not use the word term ESG, but something else. But I would love to hear your thoughts on where do you see the future for ESG as it stands today?
So I can start on this one. For whatever reason, ESG has become a politicized term. I think if you look at, some of the discourse, it used to be, I think, don't quote me on this, but I think like Larry Fink's letter last year used it a lot more than it was in this year's letter, right? So I do think that there's a decline for whatever reason in using ESG as a term, but the concepts that it encompasses, I don't think are going anywhere. And frankly, I don't necessarily even think that using a different term is a bad thing, because ESG is like a conglomeration of things that don't necessarily fit together, like the E and the S, environmental and social, and then governance is like its whole other thing. And so I do think that we might see new terms being used more, sustainability and corporate social responsibility and things like that. But I don't think ESG as a concept is going away. And MJ, as you said, whether by choice or by force, I mean, people and companies and investors are going to be confronted with the impacts of climate change, whether they want to believe it today or not.
Carnetta, do you want to go first? I would just say, I mean, again, absolutely the concepts are not going away. We are in a paradigm shift here. Personally, however, I have no problem with the term ESG. Let's live with it. It's just a term. It's an acronym. Let's understand what it is. Let's stop trying to shove a whole bunch of stuff in it that don't belong there. Understand what it is, what it represents, and get on with business of actually managing those issues and addressing some of the greater systemic risks that are facing all of us, regardless of political affiliation and regardless of country. This is we're going to solve these issues: climate change, biodiversity loss, for everyone or for no one. So let's move on.
I agree with my co-panelist.
Great, thanks. The next question is, at what stage of an ESG journey should a company come talk to an external advisory team? So Tuneta,
Depends on the advisory team, depends on the advice at any stage for different
Well,
reasons.
yeah, as a panel of outside advisors, we say right away.
Right, that's
Well,
what I was
I'm an
hoping
inside
for.
advisor. I'm an inside advisor, so I also think right away. So
Great, wonderful.
I mean, it's a great question, but it deserves a little unpacking, honestly. And there's different schools of thought on external advisors, and some people think they cost an arm and a leg, and some people think, well, they're a dependency, and some people just outsource everything, and then they wash their hands of it and think, oh, somebody else is dealing with it, I don't have to do this. That's not any better. Advisors are extremely valuable. They are there to help, to support, to accelerate. They are there to bring knowledge and expertise that you don't internally have yet. Ultimately, the goal is to internalize some of that and to help you. They're not there to do it for you. And different advice, there's not one advisor that's going to help you do everything. Also, there's, these issues are multiple in nature, they're complex, and at every step in your journey, you might be needing different things. So I think it's important to understand that it's a very valuable resource, and use it well.
And to that point, that's where just involving collaborators across the organization is important, because if your focus is purely ESG without thinking about the implications of finance, the implications of supply chain, without thinking about the implications of environmental, you may not have all the questions to ask when you're thinking about bringing in advisors. You want to make sure that the appropriate stakeholders are involved in making these decisions, and that the advisor you choose understands your organization and what's important to your management and your stakeholders.
Okay, thanks. Renee, there's a question for you. What was the recent Supreme Court decision that you referred to earlier?
Oh, it's called Macari v. Moab Partners, I believe. And it addressed whether a pure omission could support a claim for securities fraud. And it came out just a couple days ago.
All right, great, thanks. MJ, so there's one other question, like, will regulatory disclosure requirements encourage companies to only report the bare minimum, therefore stifling progress on full transparency, or will it limit quality and quantity of disclosure? MJ, you want to
Yeah, real quick. I mean, there's a chance maybe, but that shouldn't stop the regulations from coming into play. I think companies that have already been producing a certain amount of information, I don't think it'll happen very often that they'll just pull back and drastically reduce the amount of information. And I think it's really about pulling in those that have not yet provided any of that information. And one thing to keep in mind, if the only constant is change, and in this space, truer than ever, the pace of change is incredibly fast. And whatever regulations are in place are going to get built upon, things are going to continue evolving, our understanding is going to evolve, and the requirements are going to evolve as well. So I wouldn't be overly concerned about that.
Well, let's see, we are at the hours. Any last words in terms of your prediction for ESG going forward? So maybe MJ, we start with you.
I don't know. I'll go last. I've been talking too much.
Tuneta?
Sure. ESG, sustainability reporting, corporate social responsibility, it's here to stay. I think it's a great opportunity for us all to look at our place in this world and how we contribute to what's going on around us. No one's operating in a vacuum, and there are real opportunities to seek out advisors and to make sure that your company is protected and doing the right thing as well.
Thank you. Renee?
So I'm going to focus on going back to what I said earlier about just from the board perspective, making sure that there's an appropriate compliance program in place and monitoring program in place so that companies understand what their ESG risks are and that they're being appropriately monitored and that they're being appropriately acted upon when risks emerge.
Okay, thanks. MJ?
I'm not sure now, should I be predicting or giving one piece of takeaway?
Whatever you feel comfortable with.
If you're not doing it, start. If you're doing it, make sure you're doing it as well as possible. This is not going away.
Absolutely. And I mean, from our vantage point, it's the same. We cover investors with over 75 trillion of AUM, and we see no change in the way they're asking and engaging with companies on these topics. So it's clearly here to stay. It's a matter of when a company, like an investor, will engage with a company on this topic and not if. Well, with that, I really want to thank all three of you for your really amazing comments and insights. Thank you so much. And thank you for the attendees for listening in on this webinar. If you have any questions, you can send it to us or you can connect with the panelists on LinkedIn. Well, everyone have a wonderful afternoon. Thank you again.
Thank you.